and welcome to a brand new episode of the Burn Your Boats podcast. I will be your solo host today, David Shaw. I'm coming to you on Wednesday, April 9th, and I'm looking at the stock market rebound here. I see the NASDAQ right now is in the green, 12.16%. I see the S&P is just a hair under 10%. In the green today. I see the Dow is a hair under 8%. The reason I am quoting you these numbers right out of the gate is I was out in Colorado last week at a mastermind group, and we were having conversations. This mastermind group is of the highest quality. There were tens of millionaires to billionaires in the room, in a very, very small, intimate group. And it's amazing how little times I heard the word tariffs. I didn't hear the word interest rates once. I didn't hear the word volatility. And I didn't hear fear in anybody's conversations, not one time. And so if you're listening to this and you've just experienced, 2 to 3 to 4 weeks of anxiety and fear, it's amazing how wealthy people who know wealthy hacks seem to live, walk, and talk in the avoidance of this emotion. And so what is it that they know? How is it that they think that while many other people are panicking, they're selling, they don't know what action to take, the millionaires and billionaires are moving forward with their lives, with their business plan. They're staying the course in turbulent times. It got me asking the question myself. So what would happen if you missed out on 10 of the market's best days? Let's say, in the last week or two, we've seen 12, 13, 14% fall in the NASDAQ. Let's just choose that. Might even be a little bit more. But today I've just told you, as of right this minute, it looks like the NASDAQ is up, 12.5%. So what if missing out on just 10 of those market best days over your investing life, what would it do to your portfolio's growth? Do you know it would cut your portfolio's growth in half? Just in half. Left with the conclusion, obviously, that emotional decisions during downturns, they often, if not always, lead to missed recoveries. You miss the downside, but you tend to miss the upside. These recoveries, particularly in these days of algorithmic trading, these recoveries happen quickly. And so I thought I'd pull out some data here. We'll have a conversation about what it looks like when volatility hits equities, but equally when volatility hits real estate. Because one thing's very clear to me is that real estate has, whilst it's much more glacial than the equities markets, real estate is showing some real signs of opportunity because of emotional decision making. And so we're going to go through some data that maybe help you, the listener, think about where we are right now and how we're sitting right now in the overall real estate market, but also in the equities market. And so let's go through some dark days first. So on Black Monday, that's Black Monday 1987, we had the largest single day drop at 22% for the Dow. That was a horrible day. And for anybody whose life savings were invested in that, that's 20% of their life savings gone in a day. The 1929 crash, 89% total decline over a 3-year period. Now, we tend not to decline over that kind of period anymore, simply because we have algorithms and bots reacting to information a lot quicker than humans did back in the 1920s and 30s. We also had the dot-com crash, so this is a period of algorithmic trading. The NASDAQ lost 80% of its value, yet the older economy stocks like Berkshire and let's say just a basket of Dow Jones stocks, they gained 25% during that period of time. But equally, so I've just told you about some really bad days on the stock market, but the biggest recoveries. So 1987 saw the Dow rebound fully in 2 years. Post 2008 lows led to a 13-year bull run. Now, I did not have financial sophistication as a backbone of my life back then. And so I was out of the market and I missed half that bull run. I missed half of it because I know it's going to go down again. No, my emotional decision making, terrible. Now I was full in on real estate. But let's talk about real estate right now. And so the real estate downturns and recovery. So in 2008, US home prices fell 12.4% that year, right? But by 2021, prices had surged 17.7% annually every year. Think about that, right? So many people get out of real estate and they're still not back in till this day. And yet prices have surged annually, on average, 17.7% in the preceding years. In 2024, so this is last year, Tampa dropped 1.6% monthly in January of 2025. Okay, so that's recently. Tampa jumped, fell 1.6%. San Francisco year on year are down 10.9%. Yet nationally, prices have grown 5.2% annually, right? And so I'm telling you here that there is some volatility in the Tampa market, in the San Francisco market, but every major housing crash, 1873, 1929, 2008, was followed by a multi-decade period of growth. Think about that, multi-decade period of growth. So what might that tell you about opportunities that are showing themselves, let's say in the Tampa market? I talk about Tampa because I'm here, but in other metros that are, we're 3 years into higher interest rate environment. And so with 3 years of lost sales opportunities, 3 years of people standing on the sidelines, 3 years of people waiting for interest rates to go down, what do we genuinely, realistically think is going to happen? Is this going to stay like this forever? Because there are missed opportunities going to happen if you are an emotional trader. So the S&P 500, for example, missing the 10 best days from 1990 to 2020 would have slashed your returns from an average of 7.5% per year to 3.3%. Think about that. That if you're trading in, trading out, that on average, you're going to reduce your returns to what you could get in a government bond. In 2020, the COVID crash, markets rebounded 50% within months after those March lows. 50%. So if you'd sold at the start of COVID, but you didn't get back into the market, all you would have done was miss out on a 50% rebound. So just remember this, that the best days in the real estate market, the best days in the stock market, they tend to follow the worst days, right? So in 1987's Black Monday, it was followed by a 102-point gain the very next day. Post 1929, disciplined investors who held on until 1954, but they saw a recovery over that period of time. And let's talk about real estate slow burn. So 10% of homes in Tampa last year were selling with price cuts. So there's a lot of sellers out there in the Tampa market right now cutting their price. Okay. This, in a way, and while they're different, they're similar. This kind of mirrors 2008's created generational wealth with a lot of investors that I personally know. So national home prices are growing at 5.4% annually, right? Long term, despite crashes. So if you go back nationally over the last 20, 30 years, you'll see that on average, prices grow by about 5.4% annually. So there is a behavioral cost to being a panicker, right? The bottom, there's an old, investing wisdom out there is if you sell at a 4% loss, you'll miss a 20% rebound. That's something to think about, right? 4% loss, I'm getting out of the market. You'll miss a 20% rebound. Now, programmatic trading has exacerbated 1987's crash, but automation now dampens a lot of this volatility. So whilst you see high volume days and big days, they tend to be limited now with automation, right? So what is the actionable part of this? Put your plan in place. Stick to your plan, right? And check yourself when there's periods of panic. Ask yourself this: was your overall thesis broken? Or is today's panic just noise, right? And have I accounted for 10-year cycles? There's always going to be a period of high growth, low interest rates, and there's always going to be a period of lower growth, higher interest rates, and things like that. And so stick to your plan, right? Try not to follow the sexiest stock or the sexiest market. I hear a lot of people out there right now saying, "Oh, go up to the Northeast. Amazing, cash flow there right now." There's amazing cash flow in a lot of these, Northeast and indeed Midwest cities because nobody's built there for the last 10 or 15 years. They missed all of the upside of the last 10 or 15 years. And that kind of tells you that that's not where people want to live. And so, yeah, you can get good cash flow right there over the next period of time. But are you going to get appreciation? Probably not. The appreciation is still going to be where people want to live. If you want to make tactical bets, take 5% of your capital, have it available for big days like today, But keep 95% of your investments in, diversified, uncorrelated holdings. Stick to your overall thesis. Lay it out. Stress test it. But stick to it. I think the idea of panicking, panic selling, and then you're going to miss a day like today. I was recording a podcast earlier on today and the market was down. I come in after my podcast and the NASDAQ is up 12%. I was going to miss that. I just stay the course. I'm pretty confident in my overall thesis and my overall wealth building framework. So I know everyone knows the whole quote, like time in the market beats timing the market. But that includes even when it's sore, even when it hurts, right? So with real estate, I've said this 1,000 times. I dollar cost average into real estate. I don't buy huge chunks of real estate in any one year, but I consistently buy every year. And I'm going to buy this year. So just know that the volatility that you're seeing around tariffs, people telling you that this is the change of an epoch and that everything you knew before is going to be different afterwards. Try not to buy too much into that. Try to focus on yourself, focus on what you're working on. Like all of these things, give everything 30 days before you take any action one way or the other. The idea of panic selling, you're going to miss all the upside when there's panic buying. So just stay the course. It's a lot less emotional. You're not smart enough, and I'm not smart enough to know what's going to happen in the future. But I know it's going to happen over the long term. House prices are going to continue to rise because the population is growing and the cost of the inputs of houses will continue to rise. At the moment, I don't care if house prices in Tampa are stable, they're going down a little bit, they're going up a little bit. What I do like at the moment is that there are buying opportunities. There are sellers right now willing to have conversations they weren't willing to have last year. In terms of my stocks, my equities positions, I haven't sold a thing in the last week or two. And sure, it hurt, but I didn't get emotional about it. I let it flow. I knew a day like today would come through. And tomorrow might be a different day. But with regards to opportunity, I did make a couple of little opportunistic bets in the last few days, and I'm glad to see a few of them may pay off. But I'll as I say, I'll pull that 5% out and I'll put it into some other opportunity. With regards to real estate, there are fantastic opportunities out there at the moment. And so if you are an opportunistic person, don't go nuts. But don't walk away and say, I'm going to come back and I'm going to wait for evidence when everything's flying again. These times right now are the times to make your bets when things are super negative, but do not change your overall course. Do not change your overall investing thesis. If you have a diversified, uncorrelated selection of equities, real estate, alternate investments, alternate forms of income, businesses, you will be fine. Over the last few days, I know for a lot of people, a lot of you listening, it's been very emotional. There's a lot of things have been happening, but most of it is noise. Try and read a good book, go for a good run, try to listen to some good music, and know that humanity and the arc of growth is always up and to the right. Stick to that, and I hope that this little 15, 16-minute interruption in your day has helped you just a little bit. Stay the course. Don't get bogged down. Don't make emotional decisions, and you'll be just fine. Now, with that is exactly how the billionaires think. The reason I brought this to you today, because I've just hung out with a billionaire, pretty much exactly what he said to me. So there, straight from the mouth, that's advice from a billionaire. Talk to you soon. Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.